start. Let's compare what's going on in Europe. Well, find out what's happening in Greece, Spain, Ireland, Italy. Those countries have been in the headlines, and it's not for positive news. But let's contrast that with what's happening in Eastern Europe. We've got an expert, Vlad Milev of Metzler Payden. Vlad, welcome to Bloomberg.
Pimm, it's good to be back.
So, Vlad, give us this comparison now. I mean, this is kind of shocking if you take a look at it, right? Economies in Eastern Europe, at least the government finances, not as bad as when you compare them to the countries that have been in the headlines, such as Greece.
I know it's interesting because we're so conditioned to think of emerging countries and emerging, whether it's Europe or Asia or Latin America, any of those regions, as more of a basket case, generally speaking, than the more developed brethren than they have. And here is a case where you have a group of relatively well-developed countries like Greece, Spain, etc., and you compare them to those supposedly emerging countries like Poland and Russia, and you find out that from a debt perspective, at least, they look a whole lot better.
Vlad, if you take a look at the countries in Eastern Europe, for example, Czech Republic, what are the government finances there like compared to, let's say, Greece?
So you can look at it from a couple of different perspectives. And just to give a sense of comparison, if you were to add the Czech Republic, Poland, and Hungary, so three of the largest Central European countries, you put together their debt, it's about 280 billion euro. The Greek debt is about 300. So in an absolute basis, the three of them make up less than Greece. On a debt-to-GDP basis, you're still looking at a very healthy comparison as well. So the Czech Republic is at about 30%. Poland is at about 50. Hungary is the only one which reaches the Eurozone average of about 80. And then you have Greece, which has been in the headlines a lot, and you're looking at something like 120 plus, assuming they've been completely forthcoming with their finances this time, which, as we know in the case with Greece, may or may not be the case.
Vlad, what about Russia? What about the government finances there? What's the comparison?
You know, that's one of the biggest surprises in this region, and surprisingly because investors are so often willing to associate Russia with the events of August 1998 when Russia defaulted on its local debt obligations. But Russia's public debt to GDP, so the government debt, is only less than 10% of its GDP. So if you compared it to any European countries, it may be actually the lowest. Russia, during the boom years between 2001 and 2007, when oil prices were high and it was taking in a lot of revenues, they paid down a lot of debt, Soviet-time debt, and they haven't really issued. So from the perspective of this ratio, the debt to GDP ratio, they look really healthy. They're just now thinking about issuing some debt this year for the first time, as I said, in a decade. So Russia is very healthy from a debt perspective.
Now, Vlad, a lot of these numbers, these statistics, I mean, they are naturally backward looking. When you look into the future for an investor, what do you think is the best economy to be investing in right now in Europe?
Well, I think you have to look into how the budget deficit has changed over the last couple of years for these countries, because at the end of the day, the collection of every year's budget deficit is going to give you the public debt in absolute and relative basis. So what we have in terms of, in a way of criticism to the Eastern European economies is that some of them didn't really use the boom times to really drive their deficit down. So by definition, they try to be on a level less than 3% of GDP just so they can satisfy one of the criteria to become a part of the euro, to be in the eurozone. And most of them satisfied that criteria in the boom years. But in the last couple of years, we've seen this relaxation on the side of Western Europe as well. And as we know, all of these countries are running deficits above 3%. So for the region, you're looking at anything between 3 and 7.5% deficits currently. And if that continues to be the case, if those countries continue to run those high deficits in the next couple of years, you could run into trouble down the line. A country to watch in this sense is Poland, which is already at a 50% level. So if you were to continue to run those high deficits, and they're at about 7.5 this year, you're going to maybe run into issues in 2011, 2012. From an investment perspective, surprisingly, and then once again, there's a lot of surprises in our findings here, but surprisingly, Hungary, it turned out to be one of the healthier ones. In fact, Hungary, which was the country with the double deficit, so it was running a budget deficit and a current account deficit going into the crisis and was hit the hardest, one of the hardest in the region arguably, has done the best job in reducing the deficit to the point where they actually may turn out a surplus at the end of this year. And it's very surprising because when you think of Europe, you don't think of budget surpluses right now. You think of deficits. So this is the market that's done the best of our universe so far this year.
Vlad, it seems as though many European countries and the United States as well, not putting away anything for a rainy day. Are spreads reflective of this government attitude? I mean, is the cost of borrowing in Eastern Europe a lot less than, let's say, the cost of borrowing for Greece?
Well, Greece was, I think in a very extreme example. And Greece, if you look at 5-year CDS for Greece, you go back to the summer of last year, you were looking at levels of 100 to 150 basis points, somewhat of a range. If you look at earlier this year, at the extreme, Greece was running at over 400 and has come down to about 300 now. So those are very high penalizing rates. If you're Poland, for example, Polish 5-year CDS, you're looking at about 95 to 100. In Russia, you're looking at about 130. So those are, obviously, there is a risk premium that you have to pay. You're not Germany, clearly, but it's anywhere close what the Greek have to pay to roll down debt and issue a new one.
All right. I want to thank you very much, Vlad Milev, coming to us from Metzler Payden, sharing us some insight and some knowledge about comparing what's happening in Eastern Europe and Russia to countries such as Greece, Spain, Ireland, and Italy.